This video is going out to all the non-ICT, non-Goldbach quarterly theory traders out there, or maybe you've heard of ICT and you don't really know much about it. This one's for you. My name is Jack. I'm with Boda Trading, and I'm specifically making this for a couple friends, but I want to put it out there for this world just to kind of introduce people to Goldbach and quarterly theory within the ICT framework. ICT, a lot of people when they hear about it, they just look at the patterns, look at an FEG or an order block, and then trade the pattern or an IFEG. But those signatures and prices really don't mean anything without context. And so, what quarterly theory is, it's like a subset within ICT that helps you frame up price delivery and see what price should do. And then what Goldbach is basically the algorithm decoded and it'll give you very specific levels. And so let's dive right in. I'm gonna give a high level overview of Goldbach and quarterly theory, and we'll go from there. So first, to zoom out, I think I need to explain what ranges are. So if you come from the traditional trading world, you think about oversold or overbought, right? So any swing high to swing low, this would be considered a range. In the ICT world, this would be called, let me turn this indicator off for a second. This would just be premium up here, and this would be discount. You obviously want to sell in discount. I'm sorry, buy in discount and then sell in premium. So that is your range. Um, this is an hourly chart, and let me turn on my days. I want to be able to see my days. There we go. So let me turn on my days and then turn these down for a second. Actually, I'll leave those there. It's fine. Don't mind these boxes. I'll explain what those colored boxes mean later. But these are days, and this is just a range, right? So a range, if you're looking at a price range, a swing high to swing low, this could be a range. Looking at a daily range, that like just one day for this Wednesday, this could be Wednesday's range, right? So we're zooming in. This is premium, this is discount. So within that day, if you bought you bought this wick, wrote it up here, that would be a good long because you're buying within the discount of the daily range, right? So that's what a range is within the ICT world, right? And so what Goldbach is basically it's a dealing range, but it's based on math, the power of three. So let me delete that. Let me turn off that indicator and turn on the Goldbach indicator. So without going super deep in the math, if you do want to learn about Goldbach, I'll put a link in the description to learn from the man himself, Hoppy, who teaches Goldbach. But Goldbach levels and ranges are mathematical ranges that are based on the power of three. And so if you look down here, let me zoom in a little bit. These are the different power of three numbers. So 1, 3, 9, 27, 81, 243, 729, 2187, 6561, and then 19683. So these are the ranges. And so what I was showing you earlier with that range, now the range looks like this. This is the high of the range, of the mathematical range. This is the low of the range, right? So that's what the current range is for this particular PO3 number. So for 6561. So right now on the higher time frame picture, we are just about at equilibrium on a higher time frame picture. So if you zoom out to maybe the daily chart and look at that range, it might make a little bit more sense. Let me see. Oh, this only goes back 30 days. Let me go back like 90 days, 3 months, so you can see what that looks like. Okay, well, it's gonna go back like that. So if you look at the range on the daily, we have a big kind of up. You'd call this an uptrend as traditional traders, and then we're coming back down, and we're rebalancing at this range. If we consider this price range, right? Not based on, I'm sorry, call it a dealing range. A price range would be something like this: the swing low down here, all the way up to the swing high, right? So that could technically be a price range. But what we're looking at is a PO3 price range, a power of three price range, Goldbach price range based on these numbers. And within the range, they're partitioned off. Goldbach numbers are partitioned off with these numbers that are, these are premium numbers, and I'm sorry, discount numbers and premium numbers. So this three number, this three level, will will be the equal level up here will be the 97, right? Because each number on the premium or discount will have to equal 100. So meaning this 11 plus 89, that equals 100. So it's always broken up into um, two ranges, right? So um, it goes on 77, 23, 71, 29, 65, 35, 59, 41, 53, 47, and then 50 is EQ. It's right in the middle. So that's essentially, without going too deep in the math, that's the these are Goldbach levels, institutional levels that price reacts from. So if you could see, I mean, you can just looking at this range here. Let's move this back to, um, let's go back 120 days, and you'll see that price is respecting and having reactions within these ranges, right? So what has happened is we reached at the end of this range on the daily. We This is an extension of the range. So price is allowed to extend to this range, and then once it pops back, these bodies are respecting the high of this range, and so now we're gonna draw back to equilibrium of the range, which is right here. Because what price typically does is we'll extend to one end of the range, either the premium or the discount, and then we'll come back to equilibrium. Then depending on what we do in equilibrium, we might draw back down here or go back up. So that's essentially what Goldbach is. It's just really using these an institutional power of three dealing range to gauge order flow and see where where you can execute a trade or where you can expect a reaction to come from. So, for example, this is called the GIP level. Actually, let me zoom out again. So, based on these Goldbach levels, the reason why these are these numbers, these Goldbach numbers and levels, the reason why these are important and how they coincide with ICT is that they coincide with ICT PD arrays. PD arrays stands for premium discount arrays. Basically, premium and discount price patterns that you can see on the chart that will align. So this RB stands for a rejection block. That's basically a wick. So something that wicks in. So I bet on the 4 hour, this would be a wick, or look somewhat like a wick, right? Let's see. Okay, not quite. Maybe on the sorry, the vacuum cleaner there. But yeah, this is, I mean, on a higher time frame, like probably on the weekly, this would be a wick. Yeah, see, so that's a wick. Right? We're wicking into that, and on the weekly, boom, we're closing within this high. This is, um, so that's called a rejection block. Let's go back to the hourly. Actually, let's take at that weekly. That looks looking pretty good. This OB stands for an order block, and what do you have here? You have a down closed candle within this range, and this is your weekly order block right here, right? And then right here should deliver somewhere around a fair value gap, so an FVG. Like on the weekly, you can't see it, but maybe on the daily, there's an FVG right there. So right there, there's your FVG. It's called or a bearish FVG is called a SIBI, sell side imbalance, buy side, uh, sorry, sell side imbalance, buy side imbalance, SIBI, SIBI, yeah, something like that. But that's where that imbalance is. And then this is a LV stands for liquidity void. So it's I'm not actually quite sure what a liquidity void is. I think it's like another imbalance. But liquidity void is this right here. It's these little gaps in between candles. That's what I understand a liquidity void is. And then this is a breaker. BR stands for breaker. MB stands for mitigation block. And this is equilibrium. And then going further down, it's just the opposite on the discount side of things, right? So that's how Goldbach aligns um, with ICT PD arrays, right? So that's kind of a high level overview of Goldbach. Now diving into quarterly theory, the basic premise of quarterly theory is that time is fractal and price is delivered in quarters. And it's all, like I said, it's all fractal. And so, for example, a yearly quarter would be broken up into, the first 3 months, January to March, then April to, I don't even have my months correct. You know what I mean, right? Each quarter of the year, right? So we just open up a new quarter of the year. Even to the day, each day has 6 hour quarters. Sorry, let me go to each day is broken up 6 hours. Let me go to let me break it down from the yearly, monthly to the weekly. So for the yearly, we have obviously quarters in the year. For the monthly, we have quarters within the week 1, week 2, week 3, week 4. Within the week, we have quarters within the week, and the way that it works for weeks is that Monday, Tuesday, Wednesday, Thursday are the quarters, and Friday is not counted within the quarterly theory. It does its own thing. So this is quarter 1, quarter 2, quarter 3, quarter 4. Within the day, there's 6 hour sessions that make up the whole day, right? So Asia, so let's go here. Asia session, um, London. Is that right? No, hold up. Right here. Asia session right here, London, New York AM, New York PM. So that's your quarters for the day. And then within those 6 hour sessions, they're broken up into. Is that right? Hold on, maybe I don't have my. Let me make sure those are shown. I don't think my 6 hours are shown. So, oh yeah, they're not shown there. Let me make that box a little bit bigger. There we go. All right, so there's the quarters of the 6 hour quarters. There's Asia session, there's London, there's New York AM, New York PM. Okay, and then that's broken up within, I'm going to make this 100 again. And that's broken up within the 90-minute sessions, broken up into the 22.5-minute sessions, and so on and so forth. And this is broken up even down to if that's broken into quarters, it's like a 5 point something minute sessions. But I don't have those marked out. My indicator, it just goes down to we call it the micro quarter. So the basic premise is that price is fractal, and there's a concept called the true open. And the true open is the open of the second quarter of whichever fractal quarter you want to think about. So, for example, the year's true open is going to be April, because April is the second quarter of the year. Let's see if I can see this. Let's look at weeks. April is the second quarter of the year, so that's why it says, do I have my true year open up here? Maybe it's seen on the daily. Should be showing a true year open here. I think it's mixed up with true day open, and true year open is the same marking right here. But the true year open is essentially April 1st, right? Because it's tracking April is the second quarter of the year. So that's the true year open. If you look at the week, the true week open is Tuesday. So let's look at the hourly. So true week open is midnight on Tuesday. I'm sorry, midnight on Monday, because it's the second. That is the second quarter of the week. So it's actually not Tuesday. It's basically midnight, right? So since this is I'm in PST time. This is EST time. Tuesday is the true week open. Sorry, true week open right here. TSO, TWO. My apologies, right here. So it is. I apologize. It is 6 p.m. Is a true week open for 6 p.m. Monday. It's basically a start of Asia session, because that's the second quarter of the week. We go down to the 90-minute sessions. Again, I'm just giving you more examples so you can see what this looks like. The true session open is going to be that second quarter. So for this, the true day open right here, I'm sorry. If we go down to the daily quarters, the true true day open is midnight because it's after Asia session. London session opens up at midnight. That's the true day open. And what these true opens mean are actual. You remember how we talked about premium and discount in this particular. Let's say we look at Monday's range from this high to low. Premium and discount, that's a price premium and discount. But now we're looking at a timed premium and discount. And in this case, the premium and discount of Monday is right here. So anything below true day open is discount. Anything above true day open is premium. So when you stack the true opens up here and you're below all the true opens, true New York open, true PM open, true day open, true week open, you're more highly probable to look for longs because you're under the true opens. You're in discount time wise. You're in a discount and you want to look for longs. TMSO stands for True Micro Session Open. So that's the basic premise of quarterly theory. Is that, well, actually, there's um, another not caveat, but another main concept of quarterly theory is AMD and AMDX. So a main concept within ICT is AMD, which stands for Accumulation, Manipulation, Distribution. And it's traditionally taught within ICT circles is as um, a open, low, high, close. Let's see if we can find a example here. I mean, yeah, let's look at this. So we had the open of Monday, open low, we wicks down, and we close lower. So we're a red day. It's not a really good example. Let's do, okay, here we go. Open, high, low, close. So look at Friday, we open here, wicked up, and then we just distributed down and closed low here. So this accumulation is seen obviously right here. This is a really shallow, back and forth price action. Manipulation is higher in this red, and then green is distribution, and the blue is continuation. So within the traditional ICT framework, it's thought in of as threes, like accumulation, manipulation, distribution. Within quarterly theory, there's an X factor, meaning that the first and the fourth quarter can be interchanged. So in this case, it was accumulation. This is an obviously manipulation, went up, distribution down, and then the fourth quarter could either be reversal or continuation. And in this case, it was continuation and it went further down, took out this low and continued lower. So in some cases, it's let's see. So here, let's look at Monday here. So this case, it was reversal. So this is X. So here, let me mark this out. Where's my letters? So this is A. M. D. And then X. Okay. So AMDX. Oops. X. Okay. And so then, or it could be XAMD. Those are the only two combinations of price delivery, AMDX or XAMD. In this case, on Monday, it was X. And X can either be continuation or reversal. So it's X, A, M, D. That's what Monday looked like. So this was X, which is reversal. We reversed here. A is accumulation. M is manipulation. We manipulated up. And then D, distribution down, taking out X, Monday low, right? So that's how that delivery happened. But that's what you'll see on all fractal timeframes, whether it's the yearly, whether it's the monthly, whether it's the micro quarters. That's what you're going to see, and that's the basic premise of quarterly theory. And the reason why I love it is because it is just more accurate and precise than the typical AMD, teaching with ICT. Instead of thirds, quarters makes a lot more sense because if an algorithm is running the markets, which it is, and it was purely just on just on AMD, there's no X factor. It would be really easy to predict what is going to happen. Oh, this is obviously accumulation, manipulation, distribution. But because there's an algorithm running it, there needs to be an X factor to keep people guessing on which phase of the cycle price is in. So, to keep people guessing it, to make it hard, obviously, right? Because if it was easy, everybody would know and recognize which price delivery we're in. And um, anyways, so that's a high level kind of overview of Goldbach and quarterly theory. Now, how do we use Goldbach and quarterly theory in conjunction with each other? Glad you asked. So I'm going to turn back on my quarterly theory and my Goldbach indicators here. And let's look at today's price action and just kind of do a review. And I'll explain what some of these things are. A lot of these numbers that you're seeing on the screen. So right now I'm looking at a higher time. A higher time frame. I'll look at I'll look at traditional price range. I'll keep this on the hour, and I'm gonna make this a little bit smaller. I'm gonna take this off and bring it up to 100 again. For that, okay. So on hourly, let me turn off some of these tables here. So let me turn this off, and okay, cool. Let me turn those two off. Okay. So what I like to have on my charts is my minute chart here, where I'm executing, and then my medium time frame, like a 9 minute. Well, that's a Goldbach time, but you can use like a 50 minute per se. Let's just use a 50 minute on this one, and then on this we'll keep it as an hour. So hour, 50 minute, 1 minute. Let me just make this out. Okay, so on the 15 minute, I have the power three number I like to use is a 729 uh, PO3. The hour or anything above an hour, I like to use the 65, 65, 61. What's going on with this? Timing out. Let me delete this here. So, and then on the 1 minute, I keep it at the 243. Okay. So, what? Actually, let me explain these zones here in Goldbach, and then that'll help um, frame up what we're looking at. So, we talked about premium discount. Um, Let me go back in time to see. Actually, no, it's fine. We'll look at this. Okay, so we talked about premium discount and how price is delivering. Um, another, let's see here. Another thing to understand is, uh, I guess, market maker models, meaning the left side of the curve and the right side of the curve. What I mean by that for those non-ICT traders is that, let's look at this time frame, the hourly. Here. Okay. So the way that ICT traders see price is through what's called market maker models, and it's either market maker buy model or market maker sell model. So let's look at this piece of price action right here. Let me turn off Goldbach and just leave that on. So um, this would be the original consolidation down here. So basically, the way that ICT traders think about market maker models is that there's a right side of the curve and then a left side of the curve. And the reason why price is delivering from one side of the curve to the other is to generate liquidity and then take out liquidity. It's to engineer liquidity and interest in the market and then to take all that liquidity out with a run. So this is the original, they call this the original consolidation, like where the original low was. This is the left side of the curve. And then boom, I'm sorry, that's the left side of the curve. This is the right side of the curve. Um, and I guess I want to explain that because obviously price doesn't deliver like that. Price delivers in a jig back and forth manner, creating highs and lows, right? And then within all those little highs and lows, there's market maker models within those, and in a shorter fractal time frame. But that's um, a real high level overview of a market maker buy or sell model. And we throw in what we talked about earlier, ranges. We look at this range. If we sell, I'm sorry, we buy in this discount of this range, we sell up here, and then it delivers back to the end of this range, taking out this liquidity. We sell up here, buy back down here. That's your play, right? Essentially, that's what everyone's really shooting for. And how can we actually tell if price is going to do that with Goldbach and quarterly theory? And that's what I want to dive into next. So let's turn this back on. I just want to go through a brief overview of market maker buy and sell models without getting super deep into it. But essentially within this market maker sell model, in this case, well, this is a bottom buy model up here. We took out these sell stops, I'm sorry, buy stops up here, and then we went back down. So within that, there's a certain algorithm that that is going to create certain signatures in price, PD arrays, to come up and down, hit this PD array. There's a zoom into this price action right here. Turn this off. Okay, let me turn this off here so we can make it clean. So we can also look at this here. This is going to be your left side of the curve, right side of the curve. This is your sell model all the way down here. This is your buy model. But the way the price is delivering, it's creating buy stops up here. So everybody that's going short, they're placing their stops at this high of this wick, for example, right? And then so on and so forth. So more people are saying, oh, I want to get in short. They're doing the same thing here. They get in, they place their stops at the high. They get in, they place their stops at the high. You know, whatever it is, right? And then, boom, there's a smart money reversal, SMR, down here. And then price is going to go back up and take out some of these buy stops. And in this case, it took out these buy stops right here. So I'm going to draw a line. I just not, come on, shift. Anyways, it's not going horizontal, but it takes out those buy stops right there. And then the same thing vice versa, right? So I just want to explain that's what a market maker sell or buy model is that we're trying to catch and identify which program we're in. Are we in a sell program or are we in a buy program, like that? And within that program, there's a certain rhythm or algorithm that price will do. It'll say, we're going to create a rejection block right here. Then we're going to go back, create an order block right here. We're going to create a FEG right here. And then we're going to create a liquidity void right here. And then we're going to create a breaker right here. And then we're going to create a mitigation block right here until we pass equilibrium and then go down to our final objective, which is down here for this particular day for price. Then we create the SMR, smart money reversal, and we're going to do the same thing, going back up. We're going to create a little rejection block down here. We'll create an order block right here. So I'm going through this really fast because hopefully it's not too fast for you guys, but little wick is that rejection block. This is an order block right here. We're going to create a BISI, bullish FEG right here, these lines. And we're going to create a breaker, which is this big candle right here. Then we're going to create a liquidity void. We're going to create all these things going back up the ladder, going up the ladder, and then taking out these sell stops that we're laying right here, right? And then we create another SMR, and then it just does the same thing over and over again. Oh, like that's what the market does. And so what Goldbach and quarterly theory does, it tells you when you expect price to happen and what prices you expect price to do based on the quarters and based on the levels, right? So let's all that to say, hopefully you guys are still with me and you're still following. Let's get down to actually how to use these Goldbach levels to frame up a trade. So now remember we talked about premium and discount. This is your new premium and discount based on Goldbach levels. So this is your high, this is your low, this is equilibrium, right here. So a lot of times you'll see price, we broke below the high of this dealing range, and then we're respecting this high of this dealing range. Let me go to that weekly chart because that was see that pretty clearly. So wicked up into the high, almost wicked up into this extension. We came back down, we wicked back into this rejection block level, this 97 level, came back down. Your bodies are closing below this GIP level. Now GIP stands for a Goldbach inversion point. So these are really important levels, this 83 and 17 level. These are the most important levels within the Goldbach framework, 17 and 83 levels, because those act as inversion points. That's what they're called, and you'll just see price really sensitive to those. So as you can see, price tapped into that GIP, came back up. We wicked this GIP, came back up, and then once we broke bodies close below, we're going to wick up and then see that we're going to continue lower. The flow gate, the 77 to 65 level, or the 35 to 23 level on discount, this is on premium. That's going to be a flow gate, and what price typically does in this area is that it won't stay. You can trade from like one level to one level to one level, but typically price will flow through here using it as support and resistance to rebalance and go to the rebalance layer, rebalance levels, which is that 53 to 47 level right here. And then that's basically how you frame up a trade. And so if you hear talk about aim for 50%, or in the ICT world you hear a lot about 90%. If you have your first partial at 50% at equilibrium, 90% of the time, or whatever percentage, a really high percentage of the time, price is going to deliver there. And so if you have two targets, with one being at 50% and the next being at your final target, whether it's external range or whether it's whatever it is that you're basing it on, 50% will most likely always get hit. And so within this framework, we're expecting price to deliver down and hit at least 50%, and which is what we're doing right now with current price action. Or I don't know if this is current. I think I'm still in replay. But anyways, with this particular price action, right? So that's how you use essentially these Goldbach levels to frame up a trade. What this indicator does is that it actually tells you the sequence. So right now, this indicator is saying on this higher time frame on the daily, we're bearish, and now we're primed to sell at this 83 level. So once we've broke below this high, we've wicked it, and we come through this flow gate, and if we come back and retrace back to this skip level, this 83, we want to sell there to aim for the 11 level, this order block, or anywhere around here. But the final objective is this 11 mark. And so this indicator is saying that, hey, if we come back up, hit this level, go back down, use this as resistance, and your final target would be somewhere around here. That's what this indicator is saying. And that's what price delivery does essentially. It's saying it's saying that on the regular you should be seeing an order block be created here, an FEG be created here, a breaker, liquidity void around this area, a breaker around this area, mitigation block around this area, and then so on and so forth. So that's how Goldbach and ICT aligns, and the way that quarterly theory works is that you wait for the particular quarter to actually see what you're doing. So even without turning on the quarters here, I can tell that this is like an accumulation quarter, and then distributions down here. So let's see if I turn this back on. I'm on the daily. This indicator only works on like the lower time frames, so it doesn't mark out my weekly quarters. So let's go down to the hourly. So actually, let's get out of the hourly, and then let's go down to an actual execution and how you can frame up a trade with these indicators and with this framework of what you just understood. So let me leave this. Let me just frame up and look at today's price action because it was super clean. Yeah, we're super long. So let me just frame up my trade at um, frame up my trade for, let me reload this here. Frame up my trade for market on close, the last 15 minutes a day. Okay, what's going on here? Yeah, I got too many indicators open. Gotta make my, okay, so, okay, what's going on? Taking a while. Enable that. Okay. Let's go back, replay, and let's go back to here. Okay. So the way this indicator works is that on the 1 minute, I have it at 243, and I have these higher time frame GIP levels. So this is a GIP level on the 2187, and then another GIP level on the 729 right here. So these are just confluences that you can use um, to frame up your trade to see how price is reacting from those levels. I have my quarterly theory um, boxes over here, and then my Goldbach on the right on um, my execution window, and then on my higher time frame, kind of middle time frame, higher time frame windows, I have the 1 hour and the 50-minute here to see how price is flowing through these different gates. So let me just go like this. Let me turn off. Typically don't have this on. I just want to see, yeah, something like this. Okay. So at this point on the hourly, higher time frame, yes, there are some major gaps here. This balanced price range, um, but from the Goldbach level, we should reach this 71 level. That's we kind of tap back down. We should kind of go back up. Um, if we turn on we change this to be lower one, 2187. You're seeing that we're still in the discount layer. So this is the low of this higher time frame dealing range, right? So you can expect price to go up because we're finding support. See, we broke above, we wicked below, and we're finding support at this low of the ceiling range, right? So that's why you can expect kind of higher prices. And there's a lot of liquidity here. There's near London Open, previous day high, PM Open. I'm sorry, New York Open. A lot of levels that have not been hit yet that are key liquidity points that price will draw towards. So that's what was framing up the trade for this. And then of course the GIP levels are good draws on liquidity as well. So the 17 level is a good draw on liquidity. So you know the price is gonna. This is aligning with GIP level. So they're not only used as inversion points, but they can be used as targets as well. So um, I'll go back to the 6561, which was what I was using. But I just want to show you that that's kind of how you use these levels. The main point I wanted to show is that you're in discount within that range. And then even on the higher time frame PO3 range, the 6561, we are in premium. So we're at this premium gates. But that's why it's kind of nice to look at different time frames. But that's the way I was kind of framing up the trade, is that on the, I'm going to actually keep it on 2187. And then on this is for 723. And then I'm looking at the 723 levels. Make that bigger. This one 723 PO3 range. And again, we're holding this low. This is the same low, and we've held above the skip level on the 723, and we're flowing through and potentially going to hit the equilibrium, right? So that's another confluence to tell us that we're going to go higher. Tell me that price is going to go higher. Now, what this is, I'm going to zoom in on the 1 minute here. So this table right here is saying how many lows are stacked. So the more stacked lows or the more stacked highs we have, the stronger that low will be and work as support. So this 24,300 level, that is what this particular range where from where price is at. This is saying that, hey, this is a really strong support. So look for buys, essentially, right? And so we'd already created an SMR here, a smart money reversal here. And now we're looking for longing, even on this 1 minute, 243 power 3 range. We're in a discount. We know that we're going to hit probably rebalance that lines up with London high and previous day high lines up with this flow gate up here. And so going into power hour or market on close, which is the last 15 minutes of the day, I was looking for any S&T, any retrace to go back down here and then draw back up into my final target was 24,400, I think was my final target. Final target was 24,400. Nice even price level. And then my first TP was around this middle flow gate right here, 370. So that was my first target. So I was wanting to see a retrace with an S&T at the bottoms. I don't want to get super deep into my trade model right now, but I didn't get that. We didn't get that retrace. So let me just play it out. But I did enter on the 50 candle, I believe. So there's the 50 candle. That's right. I entered right here because I saw this big BISI. Pause it right here on the 15 second. This is the nice bullish FEG. And I had a limit order right there. So I had, just a couple, 2 points of drawdown. And then that was my trade right here. Whoops. So let's talk about this trade and why I was pretty confident that we were going to go higher. Not only the Goldbach levels of what I just shared with you, but let's look at the actual quarters. So we look at let me turn this off for a second, the 90-minute quarters, and just leave the 22-minute quarters right here. Give it a second here. That should turn off. Okay. Let me turn off some of these true opens. Okay. So turn this one off as well. A lot of things look. Okay. So this is a lot cleaner. So I have another free indicator by day, quarterly theory indicator on the bottom that shows the different quarters. So this quarter was so again, this could be AMDX or XAMD for these quarters, right? And so what I was seeing here was since this was the manipulation quarter of the 90-minute quarter right here, this whole range right here, that's manipulation. We had an S&T, so what that means that ES or YM took out this low, whereas NQ did not. And so this is going to be this would be your manipulation. But since it didn't take it out because of the S&T, this would be the XA. This looks like a very obvious accumulation. And this would be your MD. Well, this is more like your A and then distribution because we didn't really manipulate. That's why I was expecting manipulation down here, but we just never happened. But this price is just in a rush to get here before before close, right? So we played out. That's why I got in right there. And this was an obvious accumulation. And then looking at the green box, typically that's the highest probable time that price will deliver and do a really quick, clean delivery. So that's why I was pretty confident in this trade going into the highs. So we play it out. Boom, we went higher. And we created a small S&T up there, which is like we just edged the TP. And then later on, I was out on the chart. I just closed it. I took my first CP and then closed my second one, and that was my trade of the day. That was my trade. So, but eventually we did hit that at that target. I think in a couple. Yeah, there it is. So there's a target. So that's how you frame up a trade with Goldbach levels plus quarterly theory. Um, there's a bunch of other things I can go into, but that's essentially the kind of nuts and bolts of it. There's also these confluences with Goldbach time with these time nodes at the bottom. That's another confluence added to know that this was a new delivery cycle. This is also saying for this particular, well, if we rewind actually, my indicator here was saying this is, oh, it was saying it was bullish, but it's derailed. Okay, so let's play it out here and let's see what this says. So this gives us an indication if we're gonna go higher. So boom, okay, we went way higher. Now it's just derailed because we never got back into the gap level. And then once you created a new high and broke above this range, whoop, going too fast, hold on. Anyway, it's not doing it right now because of the replay and how fast it's going. But um, I don't use this all the time, but for cleaner moves, like let's say for this one right here, this is probably pretty clean. I bet this would be a good short that'll show on the indicator. So let's see where price is at. Okay, so now it's primed. Oh, it's waiting for a bullish play. Oh yeah, because we broke above this one level and we never retraced. So um, let's look at this one. Let's look at this. Bearish, primed. So now it's saying that hey, we hit the entry, a limit sell here. So that's really hard to see. Change this back to yellow. Hit limit sell, and then the first target should be this imbalance. So let's see if price does that. Now it says that's sell, it's live. First target is 50% EQ, and then next target is 11 OB, meaning the 11 OB is this right here, 11. So the price, we would want to do something like this, go chop around a little bit, and then deliver to here. But if you just take a first partial at equilibrium, you have higher probability of just taking that as your first partial. So let's play this out, see if we hit the imbalance. Okay, we don't. So that's when the play is invalidated. There's probably S&T, yeah, right here. So there's daily S&T with ES and YM at this low, plus a Goldbach time node. So that's a really high probable SMR, so wouldn't take that trade, right? So I didn't see that just now, but that would invalidate this particular trade idea. But now we're going long. We're still within this range. Once we break above this range and hold, now we're in a new range. Now we're in a bullish range, and we're hunting, and we're seeing if we break above this dip level and retrace down for an entry. Let's see what happens. Bullish, bullish. Okay, now it's primed and it's waiting for a retrace to hit the 29 level, or sorry, the 17 level. It says, hey, 29 was hit, but now we're waiting for 17 to hit for an entry, which I think in this case we never retraced back down there. We came back into the 35 level. Wait, 29 hit. Oh, wait. See here. I was not. Okay, so, and then we just deliver straight up, I think. So now it's waiting for a ideal entry at the 17, but price never gets there. We kind of tap into, let me have this go left here. So we tap into this 35 a little bit. No, we barely missed it. So we tapped into this 41 level, breaker level, retrace back into the breaker level, create a little nano SMT. which was that protect low, and then price delivered all the way up to our targets. So um, anyway, so I wanted to just kind of walk through some of that stuff, turn that back on. And that's essentially how I frame up a trade with Goldbach and quarterly theory. So with my indicators, kind of how I frame everything up. So my model is essentially that it's an SMT, it's a higher time frame analysis, expecting price to go where at what time, and then drilling down um, to my 1 minute and seeing which confluence I see to frame up a trade. So hopefully that kind of gives you a high level, kind of in the weeds um, picture of my trade model and the indicators and how I use them. And yeah, hopefully that frames it up. If you guys are interested in my indicators, I'll leave a link in the description. Um, you can get the Goldbach Master Suite. This is basically like 3 indicators all in one. And then the Quarterly Theory Master Suite, which is a 4-in-1 indicator. So you're really getting like 8 indicators, in one. And plus there's the FEG, I'm sorry, an SMT indicator as well that I have that is, I mean, it's key to my model. Looking for divergences, and so though that's available as well. And I'll leave the link, and that's it. So thanks for sitting through this long video. Hopefully it was helpful for you guys. Once again, my name is Jack with Voted Trading. If you like this type of content, make sure you like and subscribe, and I'll see you guys next time. Peace.